You're up late scrolling through real estate listings, and every decent home is priced at least $500,000. The countertops are outdated, the carpets scream yesterday, and there's questionable decor in the basement. But still, somehow the listing tries to sell this as a starter home. You stop and contemplate the absurdity of it all. Is it really possible that your wages are just out of step? Or is the housing market in a fever dream? Spoiler alert, it's not you, it's the math, and believe me, the math is terrible. Let's be real. My name is Miles, and today we're diving into one of the most brutal realities of modern life. Who can actually afford a house in 2026? Not who gets bank approval for a loan, but who can genuinely afford a mortgage while keeping a life worth living. Because there's a seismic difference between qualifying for that loan and actual living expenses that let you breathe easy after signing on the dotted line. Here's the stark reality check. In many markets across the US, $500,000 is the new normal asking price. This isn't a mansion either. It's barely a decent-sized 3-bedroom, 2-bathroom box with a backyard smaller than your car. In places like Boston or San Francisco, $500,000 is presented as typical, demanding that regular folks come up with regular money for oddly mediocre homes. Let's break it down even further though. The median household income in America is around $84,000. This figure places an unreasonable expectation on individuals to somehow scrounge up enough for homes that cost over 6 times their annual pay. If that doesn't seem outrageous to you, you might need to adjust your scales. I understand the messaging is loud and pervasive because they're saying things like you can make it work. But just because the mortgage guy gives you the green light and your parents manage with less, it doesn't mean it can work. But here's the cold, hard truth. Everyone's lying about what affordable really means. Starting with the down payment, which is where most might as well let their dreams hit the floor. The standard expectation is 20% down on that $500,000 home. You know what that breaks down to? A whopping $100,000. Let that sink in for a moment. The media says we should save, but the average American savings account is barely hitting $8,000. So, how exactly do you plan to overcome that $92,000 gap? Maybe you think, I can save 10% of my income. But even if you could manage that, and let's be real, most people can't, you're putting away about $8,400 each year. That's still 12 years to just reach the down payment target, assuming housing prices somehow don't keep going up. So let's say you go for the more common option, a 5% or 10% down payment to get in the game. Congratulations, you just triggered a new expense called PMI, private mortgage insurance. It's a lovely monthly bill tacked on for the crime of not being able to cough up 20%. Now you can expect an extra $200 to $400 monthly, depending on the loan type. You're paying the bank to protect itself from you. So let's lay down the numbers on your mortgage. If you manage to put down 10%, that's $50,000, which means your loan is now around $450,000. With interest rates hovering around 6% or 7% in 2026, your monthly mortgages will likely be around $2,750 to $2,850. Mind you, this just covers the principal and interest. Now, let's layer in property taxes, typically ranging from $4,000 to $8,000 annually, which translates to about $500 monthly if we're playing it safe. Next comes homeowners insurance. With climate change affecting dynamics worldwide, rates are soaring. Expect to shell out an additional $250 to $350 per month. Then there's maintenance, an item that sneaks up on you until it's too late. A good rule of thumb, budget 1% of your home's value per year for upkeep. So for your $500,000 house, that's roughly $5,000 per year, or about $417 every month. Don't forget the PMI we touched on earlier, another $200 to $400 at a minimum adding to your bill. Let's sum this all up though. Your mortgage, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. That brings your total monthly housing cost to around $4,367. And this is before anything even goes wrong. Before we move on with the video, I want to tell you about Roy. It's the only tool that takes all of your financial data, which is your income, your expenses, and your debt, and automatically tells you what you can actually afford. The reason this is so valuable is because instead of a bank or a real estate agent telling you what you can actually afford, which really all they're trying to do is make a sale, you can listen to the most objective tool on the market right now and get something that actually applies to your specific financial state. So before you make the mistake of buying a home that doesn't fit your budget, make sure to ask Roy. Now, where were we? Oh yeah. Financial wisdom suggests you keep housing expenses under 28% of your gross income. However, if your total monthly housing cost is $4,367, that would require you to gross an eye-watering $187,000 annually. Even if we adjust for the more lenient 43% debt to income rule, you'd still need to pull in about $150,000 a year. So who exactly is buying $500,000 homes? It turns out those earning above $150,000 annually represent only about 10 to 20% of American households. If we do the math, that means an overwhelming 80% of people can't afford a house at that price without gaining substantial financial strain. You might wonder, but people are still buying these houses. Who are they? Many have dual income with lucrative careers, some have financial help from family, while others are stretching their budgets to the breaking point, risking their financial health on a jagged edge. Let me introduce you to a fictional couple we call the Parkers. They're both professionals with a combined income of $160,000 a year. Sounds solid, right? But when they look at that $500,000 house, reality starts to unravel. Their gross income looks great on paper until the weight of taxes, contributions, and other deductions. They take home about $9,500 monthly. After deducting that $4,367 housing cost, they're left with around 5.1K. Let's break this all down even further. They both drive, so 2 car payments chew up about $800 monthly. Add up another $250 for car insurance, $300 for gas, and about $600 for student loans, which they needed those degrees to qualify for their mortgage. And lastly, toss in another $400 for health insurance premiums that their jobs don't fully cover. Oh wait, but there's actually more, because by now, groceries for basic food might stretch their budget to about $800. Now what about the utilities for their bigger house? That's roughly $450. Now they're down to $1,533 for everything else, like clothing, kids' activities, medical expenses, or even just enjoying life every once in a while. They're racking up a serious percentage of their take-home pay. At this point, the couple is spending about 46% of their monthly income on housing alone. Not 28%, not 35%, it's nearly half of everything they earn. These aren't reckless individuals. They're just trying to exist in what the market deems normal. So what does it feel like day to day? It's the agony of watching your bank account before deciding between necessities like groceries or unexpected bills. It leads to moments of saying no to your child's field trip or pushing repairs on your car because you can't stretch your budget any thinner. The stress compounds even more when the HVAC breaks in the middle of summer or you get rear-ended on the road. Suddenly, every dollar matters even more. The ache of financial insecurity becomes your everyday life. Try wrapping your mind around what this looks like for households making $120,000 or $100,000 a year. Or, even worse, those living on the median income of $84,000. At this level, buying that $500,000 house isn't merely challenging. It's outright unthinkable. For median earners, it isn't about adjusting their budget. It's about understanding the fundamental disconnect of a system that blatantly disregards income realities. Housing prices have surged over 400% since the 1990s, while the median income has only jumped around 180%. That math simply can't and doesn't work. Yet people continue to pretend it does. They perpetuate the myth that homeownership is a necessary path to wealth building. Yes, owning a home can generate wealth if you can survive the mortgage long enough to see it. Telling people to simply budget or get a side hustle, it completely ignores the stark reality of a structural affordability crisis. Rent alone can consume over 40% of your monthly income, leaving little to spare for savings or investments. So what's the alternative? It's as simple as this. Understand the numbers, know your limits, or even consider a less expensive home where you can forge a path that won't leave you feeling like a financial nomad. Most importantly, there's no prize for being house poor. Just because a bank is willing to approve a loan doesn't mean you should dive in blindly. The act of buying should always improve your quality of life, not lead to endless anxiety and sleepless nights. Let's shift perspectives here. If you're looking at a $500,000 house and your annual income is under $140,000, just pause. It's time to take a step back. You're on the verge of making a significant decision that could weigh down your life for many years to come. The mortgage broker might say you're good to go. The real estate agent could tell you the market is just fine. But when the calculations don't add up, they don't take into account how you might drown under the pressure. Consider this. You may feel the pressure to buy a home, seeing friends make it work, but you owe it to yourself to face the numbers. Everyone's agenda is at play, and you don't have to fall for high-flying marketing and social pressures. Let's put this into perspective. You might be in a position to afford rent indefinitely instead of strapping yourself to an unmanageable mortgage. You can continue saving diligently or seek less expensive homes, and there's no shame in that. But what genuinely builds wealth is having that financial cushion. It's about investing wisely without feeling like you're constantly under siege. Lifting the burden off your budget means you can breathe, contribute to your retirement fund, and live a life without dread over unexpected expenses. The financial industry has expertly brainwashed us to believe that homeownership should be the default. But banks, real estate agents, and insurers thrive on transactions, not your comfort level. They profit when you secure that mortgage, but when do you gain from being house poor? If you're feeling the burden, it's okay. You aren't failing at autonomy or adult milestones, but rather it's the system that's falling short. Prices have risen so sharply that what was once achievable is now an impossible task for too many. A $500,000 home is not realistically viable for many. It is a ticket to stress, not a key to wealth. Take a moment to factor all costs, and if it doesn't feel sustainable, don't hesitate to walk away. Saying, "This isn't right for me now," is showing wisdom, not failure. There's no trophy for living on the edge of financial breakdown. Making decisions grounded in reality rather than social pressures or emotional pulls is where true success lies. You're breaking the mold by questioning whether this lifestyle fits you instead of simply accepting it. The market will distort values, banks will keep doling out approvals blindly, and experts will still advise buying as a priority. But you don't have to join that scenario. What's most powerful is recognizing when the game has tilted and getting up from the table. Find your number, balance what you can realistically afford, and don't let the $500,000 price tag dictate your life choices. Ultimately, it's knowing about the figures rather than normalizing what's around you. Stay informed, stay realistic, and steer clear of becoming another cautionary tale about the devastating cost of that home you thought you needed. the smartest choice is often to recognize when enough is enough. At the end of the day, the numbers don't lie, even when everyone else does. If this video helped you see things a little clearer, hit the like button and don't forget to subscribe. And if you want to actually run your own numbers the right way, please once again check out Roy, because guessing is expensive and the math always catches up.